Good afternoon, ladies and gentlemen. We're going to get started. We're glad you could join us for the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'll be guiding you through today's session. I'm pleased to welcome our presenter today, Bill Ryan, who is an integral instructor for OIC, providing investors with the core teachings essential for options investing. If you ever called the Investor Services line or chatted with us online, you may very well have spoken with Bill. Bill is a Senior Investor Services Specialist for the OCC. He is responsible for providing support to a comprehensive options resource center that provides information and education about options and supports all products traded on all OCC participant exchanges. We're excited to introduce Bill as he brings more than 25 years of industry experience to our discussion today.
Thank you, Alex, and welcome everybody. We're here to talk about how various corporate actions can impact options contracts and the investor's overall trading position. We have to take care of a little more housekeeping, as Alex mentioned, and we need to alert the listener that options do involve risk and are not suitable for everyone. It is important that an investor read and understand the characteristics and risks of standardized options. I carry this booklet with me pretty much everywhere I go. We have not factored in commissions, fees, margin, and taxes when discussing the results of various option trading strategies, or for that matter, even corporate events and their impact on options contract adjustments. And we certainly want to remind the listener that this is not an endorsement or trading recommendation. A little bit about OIC. We are a not-for-profit organization funded by my parent company, OCC. We offer free, unbiased options education and information. The main vehicle to deliver that info is our website, optionseducation.org. We have online videos, online courses, podcasts, webinars, and the ability to speak with myself or my colleagues in the Investor Services team. This slide gives an illustration of the tremendous amount of trading volume that has occurred in the options industry over the past 15 years or so, where you'll notice that the most recent years, 2015, 16, 17, we've been averaging options contract volume and trading volume in the neighborhood of 4 billion annually. We support, Alex mentioned that we support our participant exchanges, our member exchanges. This is a list of those. And now we get to the meat of the topic here, is a presentation outline. We're going to be talking about, first about general concepts about options contracts, and then we're going to be reviewing, half a dozen or so different corporate actions and how those impact our standardized options contracts. As the slide states, these corporate actions are declared usually by the board of directors of the publicly traded companies, and certain of these actions can result in dramatic price changes in the underlying security. Think, for example, after a company announces and undergoes a 2-for-1 stock split, the stock literally is cut in half. And there are processes and things that need to be done to make sure that there is no untoward or unfound or windfall profits, nor should there be any disadvantage to a shareholder or an option trader when there is a non-market related change in the price of the company or the capitalization of the company. Options contract adjustments are determined by the OCC Securities Committee, which is comprised of representatives of each of the exchanges that trade the affected options contract. And it's important to remember that corporate action adjustments are considered on a case-by-case basis. We have to further add these disclaimers with respect to contract adjustments. They are purely hypothetical, and they represent typical corporate actions and how a trader might expect these adjustments to look, what they might look like, and to recognize a non-standard contract. Some of the assumptions we are making with respect to these contract adjustments is that they are options contracts that are American exercise style, and that means that, and we're also talking exclusively about equity options or options on an individual stock, or for that matter, even an exchange-traded fund, an ETF. Further restriction here or requirement is that these contracts have not been previously adjusted. They are a standard 100-share deliverable. And of course, the adjustments are based on publicly available information. That publicly available information is going to be found with the filings that the company makes with the SEC. Typically is something like a 20K filing. And depending on the corporate action, that will have an impact on the type of contract adjustment that occurs. So let's review some of the option basics. All right, an standard options contract includes the underlying ticker symbol, the ticker of the underlying security, stock, or ETF. The number of shares represented in a standardized contract is typically 100 shares. When strike prices are first issued or listed, they include in, at, and out of the money strike prices. And as the security rises and falls, additional strike prices are added. With respect to the monthly expiration of the contract, options contracts traditionally have monthly expirations, and that would be the third Friday of every month. There are other options contracts that are deemed or termed weekly. These also will be adjusted if they are in existence at the time of the corporate action. Exercise style, again, these are American exercise style. They can be exercised on any business day up to and including the expiration date of the contract. Settlement of the exercise: when an option exercise is properly tended, it results in the receipt or delivery of the underlying security on the second business day. And again, the last trading day for an equity option is the last time, we should say, you can trade an option. An equity option is at the close of business on their expiration date. So that would be the third Friday of every month, 4 p.m. Eastern, 3 p.m. Central. For equities, many ETFs will trade an extra 15 minutes. Additional standardized features of the contract: the deliverable. This is a term we're going to be using. The deliverable is the units of trade that underlie the contract. So again, we're talking 100 shares, and this is the security that changes hands when a call or a put is exercised. The deliverable can be changed based on the corporate action. A good example is when a company spins off a division to their shareholders. We would expect that prorated number of shares to be added to the options contract of the parent company. All right, now another important concept is the aggregate exercise amount, which is simply the strike price times the multiplier. In almost every case, your multiplier is going to be a 100. All right, so it's the strike price times 100. An example is an XYZ December 50 call. We take that strike price of 50, multiply it by 100. There's our aggregate exercise amount. That's $5,000. That changes hands along with the security if and when the contract is exercised and or assigned. As we mentioned, this is a standard regular 100-share contract, and if a contract is adjusted with the deliverable, again, an example of a spinoff, the new deliverable is what changes hands. The added deliverable, along with the parent company, the spinoff company, that changes hands along with the aggregate value of the strike, $5,000. Next, we have a poll coming up here. I'd like you folks to take some time and respond to this. Have you ever had a contract adjustment on an option position in your account? It's a simple yes or no question. Here's our preliminary results. Looks about 75-25. 76% have not. 23% have had an options position adjusted due to a corporate event. So let's take a look at some of these corporate events and see what these folks have realized in their accounts. Our first category are forward and reverse stock splits. There's for forward splits, there's really two categories. There's an even split, where one or more whole share is issued for each share held, for each one share held. Examples of this would be a 2-for-1 split, a 3-for-1 split, a 4-for-1 split, etc. Now, an odd split, an odd forward split, is one where one whole share and a fractional share is issued for each share held. A common odd forward split is the 3-for-2 split. There have also been 4-for-3s, 5-for-4s. I believe many years ago I saw a 12-for-10 split, but those are even rare. And then, of course, we have the reverse splits, and these are the types of contract adjustments that have people scratching their head and trying to figure out, now is my contract in or out of the money now after this reverse split? And this is where a reduced amount or fraction of shares is issued for each share held. A reverse split example would be a 1-for-2, a 1-for-5, or for that matter, even a 1-for-2.5 split. For even stock splits, the 2-for-1, 3-for-1, 4-for-1, adjustments are normally made to the number of contracts that you hold or have a position in. So the number of contracts are increased. The strike prices are reduced or decreased, and if necessary, rounded to the nearest penny. Because this even stock split results in additional 100 shares or 200 shares, as the case may be, the deliverable remains 100 shares. The multiplier remains 100. The option symbol remains the standard underlying ticker symbol. That main option root symbol remains standard or similar to the prior contract, pre-split. So a standard options contract continues to trade at the post-split strike prices, and it simply means the contracts are adjusted. Here's a classic example. A 2-for-1 stock split. The number of contracts the trader has is increased, multiplied by 2. The deliverable in these contracts is unchanged. It remains 100 post-split shares now. Strike prices are divided by 2, and where necessary, rounded to the penny. The multiplier is unchanged. It remains 100. And again, I mentioned the option symbol, the option root symbol, ticker symbol remains unchanged as well. We get a little bit more into the details on the adjustment right here. If we had a XYZ December $50 call, and the company announced and effected a 2-for-1 stock split, you'll see before the split you were long one $50 call. After the split, you're long 2 call options. Each contract will deliver 100 shares. And while your strike price was 50 before the split, after the split, it's 25. Very straightforward. Multiplier was 100, remains 100. Option symbol was XYZ, it remains XYZ. You might recognize this, for those who have experienced a 2-for-1 split, this would be very similar to what you may have seen occur. One of the things we want to talk about in a 2-for-1 split is the aggregate exercise amount. Before the split, if you owned a call and you exercised it, you would pay $100, 100 times the $50 strike, or $5,000. After the 2-for-1 split, you now have 2 $25 calls. If you were to exercise both of the $25 calls, your aggregate exercise amount remains $5,000. So that concept of the aggregate exercise amount is something that appears regularly throughout these contract adjustment discussions, and I can't stress that this is really one of the keys to understanding contract adjustments. The value of the value of the strike, the aggregate value of the strike, exercise amount. Now, odd splits, as you might expect by the name, we see some odd things occur. When adjustments are made for forward odd stock splits, we would expect that the deliverable, the underlying security, the number of shares would be increased. The contract multiplier we would expect to be increased as well. The option symbol is adjusted. The strike prices are proportionately decreased, basically by that ratio number, the 3-for-2 number, right? And then, if necessary, those strike prices are rounded to the nearest penny. Now, you're going to see in odd stock splits that the frequency of rounding increases dramatically. All right, and another item to bear in mind is that adjustments for these odd stock splits will usually not result in an increase or decrease in the number of outstanding contracts in your account. All right. So because these adjusted contracts have a non-standard deliverable and a non-standard multiplier, meaning the deliverable is something other than 100 shares, in this case more than 100 shares, the contract multiplier changes from 100, and it usually becomes the multiplier becomes and represents the same number of shares, increased shares. And because we have a non-standard option contract, the option symbol is adjusted. It is changed. And as I mentioned, strike prices will, in this case, a forward odd stock split, the strike prices are decreased, and it's not uncommon for the strike prices to be rounded to the nearest penny. Again, the adjustment is usually not in the number of contracts, it's in the meat. It's in the strike price, it's in the multiplier, it's in the deliverable, and of course it'll be in the option symbol. Because these become non-standard contracts, it's very common for option exchanges to relist a standard 100 share contract. So on the, a day or two after the distribution, the split, it's very common that you will see a standard 100 share contract trading alongside an adjusted a odd stock split adjusted options contract. It's just normal. So here's an example of an odd split, a 3-for-2 stock split. In your typical 3-for-2 stock split, the number of contracts remain the same. The deliverable increases. It's multiplied, in this case, by 1.5. The strike prices are divided by 1.5 and rounded to the penny. The multiplier changes from 100 to 150. And the option symbol changes. We'll show you a more specific example coming up here. All right, so before this 3-for-2 stock split, we owned a December $50 call. After the split, before this 3-for-2 split, we owned one $50 call that represented 100 shares of stock with a strike price of 50 and a multiplier of 100. The option symbol of XYZ, the root symbol, was in fact XYZ. After the split, we are still long one contract. Our deliverable has been increased to 150 shares. Our strike price has been reduced to 33.33. Multiplier has changed from 100 to 150. And because this is a non-standard contract, our option symbol has changed from XYZ to XYZ1. And I'm going to take a look at the aggregate value of the strike now. All right, we had again, the 3-for-2 split, we had a $50 option, a $50 strike price. Prior to the split, we exercised. It's a $5,000 worth of strike price. After the 3-for-2 split, our 33.33 new strike price times the multiplier of 150, the aggregate value of the strike is $4,999.50. This is due to the rounding factor. All right, and the premium amount. The options contract's price that's trading at the exchanges, with the increase in the multiplier, if this contract were to trade hands at $2.50, the actual money that's coming in or out of your account is going to be 2.50 times 150, or $375 post-split. All right, so we've had two examples of forward splits, an even 2-for-1 and an odd 3-for-2. Now let's take a look at reverse stock splits. Okay, with the understanding that each reverse split and each corporate action is reviewed on a case-by-case basis. For a typical reverse stock split, we would expect that adjustments are going to be made to the deliverable. The number of shares in the contract will be decreased. Since this contract went from being a standardized 100-share deliverable to something other than that, we would expect the option symbol will change. All right. Adjustments are not made to the number of contracts in your account due to a reverse split. All right. Adjustments are not made to the strike prices due to a reverse split. And finally, adjustments are not made to the multiplier. It remains 100. Provided the security, after this reverse split, provided the security is still eligible for options trading, meaning they still meet the criteria. A particular note would be the number of shares outstanding. The public float is one of the items that is looked at by the exchanges when deciding to list, or in this case, relist contracts. So a standardized 100-share contract might be relisted following a reverse split. So I'm going to show you an example of a 1-for-5. These are the details of what we would expect in your typical, for lack of a better term, typical 1-for-5 reverse. The number of contracts in your account remain the same. The deliverable is divided by 5. So our 100-share contract now delivers just 20 shares. The strike prices remain the same. The multiplier remains the same. And again, the option symbol is adjusted. So we've got the world-famous company XYZ that has undergone a reverse split, and we're going to take a look at how this impacts a $5 call. All right, before the split, we were long one $5 call that delivered 100 shares of stock. Our strike price was 5. Our multiplier was 100. Our option symbol was XYZ. Post-split, after the reverse split, we are still long one contract. The number of shares has been reduced to 20. Our strike price remains 5. Our multiplier remains 100. The premium and strike price multiplier remains 100. And our option symbol has changed from XYZ to XYZ1. And this is how you might expect the before and after split. This is how you might expect to see this represented in your own particular account. Now, a couple things we want to talk about. The 1-for-5 split, our aggregate exercise amount before the split was $5 strike times 100 or $500. Our aggregate exercise amount post-split, our aggregate exercise amount post-split is still $500. So $5 strike times 100, $500. The premium multiplier also remains 100. So $1.50 if the contract trades hand at $1.50 or $1.50. Total premium changing hands is $150. I mentioned the possibility that exchanges would be or might relist a standard 100-share deliverable. And if that were the case, we could see, or you could see in an option chain or an option montage, the standard 100-share contract trading alongside the adjusted 20-share contract for the reverse split. So we'd have we'd have the XYZ trading alongside the XYZ1. Those types of quote displays will often prompt an inquiry to my department and to brokerage firms as well. What's the difference? Why is one cheap? Why is one expensive, etc. And our example of the reverse split hopefully provides you with an idea as to why that occurs. Another type of corporate event or corporate action that could result in a contract adjustment is for special cash dividends or extraordinary cash dividends. It's important to remember that for ordinary quarterly or planned dividends, options contracts are not adjusted. It's only when a special cash dividend or extraordinary cash dividend is declared that we might see or would expect a contract adjustment. So, for special cash dividends, for contract adjustments in general, we would expect that some or all of the terms could be modified: the deliverable, the strike price, and the option symbol. And depending on how this special cash distribution is handled, the adjustment is handled, it may result in a new class of options, a standardized class of options being relisted following the cash distribution. And we can talk about that a little bit later. So, Company XYZ has announced a special cash dividend of $3.75 per share. Okay, this is this adjustment technique is very common, and it's almost always the preferred method. So, company announces a $3.75 special distribution cash dividend. The number of contracts that you have remain unchanged. The deliverable remains unchanged. It's one contract before, one contract after. The deliverable 100 shares before, 100 shares after. The strike price is what changes here. It is reduced by the exact dividend amount. On the X date, the strike prices, all strike prices, calls and puts, are reduced by $3.75. The multiplier remains 100. Option symbol remains XYZ because it's a standard 100-share contract. All of the terms remain the same, but for the reduction in strike price. So this is a standard contract. Before the dividend, we owned a $50 call, XYZ, expiring in December of 2018, a $50 call. After the dividend, after the distribution, our strike price has been reduced to 46.25, 46.25. You can see, because this method is so straightforward and I think easy to understand, this is certainly the preferred method. I'm thinking this is the preferred method in all of these distributions. So, getting back to our example of the 375 special cash, our exercise amount before the dividend, our aggregate exercise amount was $5,000. 50 times 100 is $5,000. After the adjustment, our strike price is reduced to 46.25 times 100. Our aggregate amount is $4,625. The premium multipliers remain 100. If our contract was worth $2.50 before the dividend, and it trades hand at $2.50 after the dividend, it's the same dollar, same dollar amount, $250. Some investors will ask, is it necessary for me to exercise my call option to maintain the in-the-money value? In a nutshell, the answer is no. The option strike price has been reduced, and provided everything else remains constant, all the heavy lifting has been done for you. You don't have to exercise the option. Now, there's another type of adjustment that occurs with a special cash dividend, and this, I think, example illustrates it pretty well. In this type of adjustment, the special cash dividend, a prorated amount, that dividend, that cash dividend, is attached to the options contract. So your number of contracts remain unchanged. The deliverable changes, right? Instead of delivering 100 shares, it delivers 100 shares of stock, and in this case, $5 times 100, or $500. So it's a package deal, stock and cash. Strike prices remain unchanged. Multiplier remains unchanged, and the option symbol is adjusted because, again, this is no longer a standard options contract. When the contract is no longer standard, we should expect to see a change in the option symbol. All right, so before this $5 cash, special cash dividend, we had an XYZ December $10 call. After the $5 special cash dividend contract adjustment, our option symbol has become XYZ1. That numerical suffix there is sort of an early warning indicator. It's an alert to let you know that this is not your typical 100-share contract. There's something different about this one. Now, I mentioned earlier with respect to special cash dividends that depending on the nature of the adjustment, a new class of options might be relisted that are standard terms, 100 shares, normal strike prices, etc. And if there were to be a standard 100-share contract trading all alongside the adjusted 100-share plus the $500 cash component, that's going to be the XYZ1. So with that in mind, on expiration Friday, if XYZ closes at $7.50 a share, our standard 100-share $10 call is out of the money. I mean, that's, it has zero intrinsic value, and if it's expiration Friday, you probably won't be able to sell that. On the other hand, we've got our adjusted non-standard XYZ1 that includes the $5 per share in cash, and if XYZ closes at 7.5, well, is again straightforward. 7.5 plus 5 is $12.50. Our aggregate value of our strike is, well, our strike price is 10. Our underlying value is 12.5. This contract has an intrinsic value of $2.50 or $250. It's, unless you were familiar with what the specific deliverable was on this contract, you would not realize at first glance that this $10 call is in the money. Okay, equity distributions. We're talking about spinoffs here, folks. Here's a classic example, or actually, example came out of the characteristics and risks of standardized options. If XYZ spins off a subsidiary, its subsidiary in this case is TUV. In this case, they distribute a quarter of a share of TUV for each one whole share of XYZ stock that you hold. All right. Now, since an options contract is 100 shares, 0.25 times 100 results in 25 shares being added to this contract, the 25 shares of the spun-off entity. Let me back up here real quick, and with the understanding that, the spun-off entity is that value. Before the spin-off, the value of that subsidiary was included in the price of the stock. It was included in the price of XYZ. Once the spin-off is effective, that TUV is no longer part of its parent company. They're on their own. They've graduated. They've got to do their own thing. So that value of the spin-off is going to come out of the parent companies. That's good. The value of the TUV new company is going to be subtracted, or it will reduce the value of the parent company XYZ. That's just something to bear in mind here. So, all right. So before the spinoff, we were long one XYZ $50 call expiring in December, and after the spinoff, we own one XYZ1. There's our numerical suffix, an XYZ1 December $50 call. Take a look at this a little bit more detail here. All right. If a new standard 100 share contract was issued on XYZ, and on expiration Friday, it closes at $48.50 a share, and our spun-off entity, TUV, closes at $16 per share. This results in the following scenario. Our standard 100 share contract, the December $50 call, is out of the money. Underliers at 48.5. Deliverable is just 100 shares of stock. Our strike price is 50. That contract is out of the money. It has zero intrinsic value. On the other hand, our adjusted XYZ1 December $50 call, which includes a prorated number of shares of our spinoff, this call is in the money and has intrinsic value. XYZ, 100 shares at 48.5 is $4,850. We've got 25 shares of the spinoff company at $16 per share. The value of that, of course, is $400. When we add those two pieces together, we've got a deliverable that's worth $5,250. And again, in an option montage, provided we've got the standard and the non-standard adjusted for spinoff trading side by side, you will see a pricing differential. And any intrepid option trader is going to want to find out why one contract is more valuable than the other. Here's our next segment. We're going to talk about mergers and acquisitions. All right. Here's our example. XYZ is merging into the NewCo company. NewCo company will pay for each XYZ share, they will pay the following. They will give XYZ shareholders a half a share of NEWC, NewCo stock, and $3.50 in cash for each old XYZ company stock that you held. All right. So 100 shares of XYZ converts to 50 shares of NewCo NEWC shares, and 3.5 times 100, or $350. That $350 cash amount is fixed. It doesn't fluctuate with the price of the acquiring company stock. It's a fixed dollar amount. And again, as you would expect, XYZ calls and puts, their symbol changes we've got a new deliverable, so it should resemble NEWC, and then we've got our numerical suffix that tells us this is not your typical options contract. And after the merger, NEWC1 options trade until they expire, because they do have a component, the 50 shares of NEWC, that will fluctuate in value. So we would expect that those contracts would still trade. Here's a little bit more detail. It seems like a bit of a repetition here. Number of contracts unchanged. The deliverable becomes 50 shares of NewCo and the 350. Strike price multipliers remain unchanged. The option symbol changes. Yeah, this is a repetition. Okay. Another type of merger is often referred to as a cash buyout. Company XYZ announces, we're going to pay shareholders $85 per share to accomplish this merger. This is, what we call a buyout. Before the merger, you've got a $50 call, XYZ $50 call. After the merger, after this cash merger, you've got an adjusted NewCo option. Actually, it's still an XYZ option, but it does not deliver NewCo stock. It delivers only cash. $85 per share. 100-share contract, the deliverable is $8,500. Strike prices remain the same. Multiplier is unchanged. And the option symbol remains XYZ because it does not deliver NewCo. It delivers cash. Another item about all-cash mergers is that the contracts settle to the difference between the extended strike amount, or the aggregate value of the strike. For a $50 strike price, that's 50 times 100, or $5,000. And remember, our deliverable of $85 per share is $8,500. At expiration, the settlement value of $50, the settlement value of the $50 call is going to be $3,500. If you owned a $50 call when the contract is exercised and settled, you will be credited with $3,500 in your account. Because the all-cash merger options settle to a fixed dollar amount, we would expect the following to happen. The expiration date will be accelerated. So we're changing the expiration date. If you had a contract that expired in January 2020 and this merger is consummated in November of this year, your expiration date gets pushed up. It gets pulled forward to the nearest monthly expiration date. Out of the money options will be worthless. Again, it's $85 a share. If you had a $90 call, it is of zero value once the merger is consummated for cash. Any in-the-money options will have no time value. Regardless of when they expire, they will have no time value. Bankruptcies and trading halts. These are... perhaps this title should be more properly titled, this slide should be more properly titled Trading Halts and Bankruptcies, but I think we can work through it. Now, if a company files for bankruptcy and the shares still trade or are halted from trading but continue to exist, the options contracts will settle to the underlying shares. If the underlying has halted trading, you should expect that the options will also be halted. And shares, let's see, if for whatever reason the shares of stock are delisted from a national exchange, a national stock exchange like the NYSE or NASDAQ national markets, if shares begin trading on the pink sheets or over the counter if delisted from a national exchange, the exchanges will usually announce, the option exchanges will usually announce that options for that security are eligible for closing-only transactions. You cannot open up any new positions once the security is ineligible to trade on a national stock exchange. When it trades on the pink sheets or over the counter, you should not expect to be opening up any new positions. You'll see that asterisk there in the small print, and this is something we want to point out to you. Bankruptcy is possibly a reason that there is a trading halt in the stock. It's not the only reason. During a trading halt, generally speaking, there are no OCC exercise restrictions. However, some brokerage firms may have restrictions in place for their customers. Okay? This is an issue. If you do find yourself in this situation, you will want to discuss this with your brokerage firm. Now, and again, this is applicable to trading halts. Now, if the U.S. Bankruptcy Court, upon court confirmation of a plan of bankruptcy being approved that results in the cancellation of all outstanding shares, this means the shares become null and void. And if this were the case, common stock shareholders receive nothing for their shares. And a contract adjustment will generally be made to the options in the underlying bankrupt company, meaning they will remove the stock from the deliverable. If the deliverable amount is converted to 0 shares, call options become worthless, regardless of the strike. Again, this is when common stock is canceled by a U.S. bankruptcy court, declared null and void and worthless. All right? So the shares are canceled. If the deliverable is converted to 0 shares, call options become worthless, and an investor who exercises a put would receive 100 times the strike price. So a $2 put, they get $200 when they exercise, and they don't have to deliver anything. Again, we got some small print here, folks. Although many bankruptcies do not result in a distribution to shareholders, each bankruptcy's terms are unique, and in some cases may include a distribution to shareholders upon cancellation of existing shares. Any contract adjustments for such events are determined on a case-by-case basis. I know that's a lot to wrap your head around, and it only took me about 25 years to figure it out. As this slide tells you, if you're a novice or an expert, the OIC's Options Education Program has you covered. We've got a MyPath assessment that allows the user, once they complete a brief quiz, you can learn about options and options trading at your own pace and customized to your current skill level. We also have podcasts, literally hundreds and hundreds of podcasts that you can download. We offer these webinars, and we also offer live help from myself and my colleagues over at our website via our chat function. This is all available on our website, optionseducation.org. And finally, if you are looking for more information, we encourage you to visit our website at optionseducation.org. You can email us at Investor Services. You can email our Investor Services team at options@theocc.com. I hope you folks have had a chance to look at our OIC YouTube channel. There is just some terrific information there. And we encourage you to follow us on Twitter at options_edu. Back to you, Alex.
Thank you, Bill. We have a couple questions. I know we're running short on time here, but I'd like to remind our listeners that if you have further questions about the concepts we discussed today or the tools on the OIC website, or if we weren't able to get to your questions you submitted, you can contact our Investor Services team at options@theocc.com. That's options with an S, @theocc.com. They'll be ready to help answer questions about option strategies and positions. Additionally, today's session will be archived and will be accessible in a few hours using the same link you used to join us today. And Bill, I just wanted to get to a question from Robert. Why would a company announce a reverse stock split?
Alex, that's an interesting question. Yeah, I'm sorry. That's a terrific question. And there could be a couple of reasons. I think the most common reason is the board of directors is looking to boost the share price. You know, if a company's trading at 8 cents a share on the national marketplace, these national stock markets require a certain level of share price for the continued listing of that security on the national exchange. So a reverse split is a technique that boosts the share price while it also, of course, reduces the number of shares outstanding. And in boosting that share price, it may permit or allow that security to maintain its listing on a national stock exchange like NASDAQ or NYSE.